Welcome to The Explainer. Today, we're tackling a really big idea, a major shift in how businesses think. We're asking, are your employees a cost on a spreadsheet, or are they your single greatest asset? Let's get into it.
All right, let's kick things off with a pretty simple comparison to get our heads around this. Think about the stuff a company owns. Physical assets like computers, machinery, even the building itself. Over time, what happens to them? They get old, they wear out, they depreciate, they lose value. But now think about your people. This is where it gets interesting. Your employees, your team, they're human assets. And with the right care and development, they can actually do the opposite. They can appreciate. They can become more valuable to the company over time.
So here's how we're going to break this down. First, we'll tackle that core question. Is HR a cost or an investment? Then we'll look at something called the human capital value chain. After that, we'll dive into the 5 big factors that drive this kind of investment. We'll also have to talk about the risk involved, and finally, we'll wrap up with the strategic balancing act it all requires.
All right, Section 1, HR, cost or investment. This is all about shifting the paradigm, moving from seeing people as an expense to seeing them as an asset.
So what do we actually mean by the investment perspective? Well, here it is in a nutshell. It's a strategic way of looking at your people. Instead of seeing training and development programs as just another cost, you see them as a capital investment. Seriously, it's like buying a new piece of equipment that's going to make you more productive, except in this case, you're investing in your people to maximize their value and ultimately give your company a real long-term competitive edge.
Okay, that sounds great in theory, right? But how do you actually connect the dots between spending on people and seeing better business results? Well, there's a model for that. It's called the human capital value chain, and it's all about connecting those people practices directly to the bottom line.
And it's a really simple but powerful 3-step flow. It all starts with your HR activities, the things you actually do. Those activities then create specific outcomes, how your employees behave and feel. And finally, those outcomes directly drive your big picture organizational objectives. It's like a set of dominoes. One thing leads to the next, which leads to the next.
And here's where the rubber really meets the road. Look at the examples. Your HR activities, things like your training budget or how much it costs to hire someone, they don't just exist in a vacuum. They directly impact outcomes like employee retention or the quality of the people you bring on board. And that's not just some fuzzy HR metric. Better retention and higher quality hires, that translates directly into bigger organizational goals, like grabbing more market share or boosting your profit margin. See the connection?
Okay, so if this value chain makes so much sense, you have to wonder, what actually pushes a company to invest in its people, or not to? Let's dive into the 5 key factors that really shape a company's entire people strategy. So, let's ask the big question. What really shapes an organization's investment strategy in its people? Why are some companies all in on development, while others barely spend the dime? What's really going on behind that decision?
Factor number 1, and this one is absolutely huge. It all starts at the top. The values of senior management are everything. You can tell a lot about a company by how its leaders talk about their people. Do they see them as cogs in a machine, or do they genuinely believe that their employees are the engine driving the business forward? That core belief, that vision, is what opens up the checkbook.
Okay, factor number 2 is the company's attitude toward risk. And let's be real for a second. Investing in people isn't a sure thing. It's not like buying a government bot. You could spend a ton of money training someone, get them all skilled up, and then they could walk out the door and go work for your biggest competitor. Ouch. So a company's basic comfort level with taking that kind of gamble plays a massive role.
Third up, you have to look at the kinds of skills we're even talking about. This is so important. Are the skills you need to build highly marketable? Things that look great on a resume anywhere? That makes an employee's knowledge very portable. It's a riskier investment for you. On the flip side, if you're training people on skills that are super specific to your company, your own internal software, your unique processes, that knowledge is stickier. It makes the investment feel a whole lot safer.
All right, our 4th factor is what you might call a utilitarian mentality. This is the classic show me the numbers approach. For these organizations, it's all about a hard-nosed cost-benefit analysis. They're not going to fund a program just because it feels good. Nope, they want to see the ROI, the return on investment. They're asking, if we spend this dollar, how many dollars are we going to get back? It's a very pragmatic, bottom-line way of thinking.
And our 5th and final factor is the availability of outsourcing. This boils down to a classic business dilemma. Do we build or do we buy?
If a company can just go out and easily hire a contractor or another firm to do the work, why would they spend all the time and money to build that skill set inside their own team? The easier it is to buy the talent, the less incentive there is to build it.
So, all of this really brings us back to risk, doesn't it? Let's look at the risk equation, because it's about weighing the danger of taking action versus doing nothing at all.
You've probably heard this one before. It's a classic story that gets passed around in business circles. The CFO, the numbers person, asks the CEO, what happens if we invest all this money in training our people and then they just leave? And the CEO's reply is just perfect. What happens if we don't and they stay? That pretty much sums up the whole dilemma, doesn't it?
And that little story leads to the real knockout punch. Yes, of course there's a risk to investing. Your best people might leave, market trends could change, making their new skills obsolete. But look at the other side of the coin. The risks of not investing are frankly terrifying. You're looking at skill stagnation, plummeting productivity, and eventually, you just lose your competitive advantage entirely. The risk of inaction can be so much greater.
Which brings us to our final section, the strategic balancing act. Because at the end of the day, there's no easy formula for this. It's a judgment call.
So here's the big takeaway. The goal isn't to somehow eliminate all the risk. That's impossible. The real goal is to manage it strategically. Great leadership is about finding that sweet spot. It's about making smart judgments, weighing the pros and cons, and figuring out how to get a sustainable return on your human capital. It's a constant balancing act, and getting it right is a true art.
So I'll leave you with this final thought to chew on. Think about your own workplace. Is your organization just spending money on people, or is it truly investing in them? The difference between those two words is massive. And the answer to that question will tell you almost everything you need to know about where that company is headed.